I want to start with four numbers, not because they are alarming, but because they are real, and together they explain something that nearly half of all Social Security recipients in this country are experiencing right now, and that most of them never fully understood before it showed up on their tax return. The four numbers are $25,000, $34,000, 1983, and 50%. By the time I have shown you what each one means and how they interact, you will know exactly where your own household stands relative to the Social Security tax thresholds, and you will have three specific things you can do right now to reduce or eliminate your liability, regardless of what any legislative proposal does or does not become law. I'm Anderson. I spent 5 years as a financial advisor in New York, working with families through retirement planning, Social Security decisions, and the tax side of retirement income that most people never fully model until it surprises them. What I have is 5 years of sitting across from people who were genuinely shocked to learn they were paying federal income tax on the Social Security benefit they had spent their entire careers funding. This video is for everyone who has not had that conversation yet, and for everyone who has already been surprised and wants to understand what they can actually do about it. Subscribe and hit the bell, because the rules around Social Security taxation change, and when they do, I will always explain what those changes mean for your specific situation. Now let me walk you through all four numbers. The first number is $25,000. That is the threshold above which a single Social Security recipient begins paying federal income tax on their benefits. Below $25,000 of what the IRS calls combined income, your adjusted gross income, plus any tax-exempt interest, plus half of your annual Social Security benefit, none of your Social Security is taxable. Above $25,000, but below $34,000, up to 50% of your benefit is included in your taxable income. Above $34,000, up to 85% of your benefit is included. For married couples filing jointly, those thresholds sit at $32,000 and $44,000 respectively. These are the numbers that determine whether you pay this tax and how much of your benefit is affected. Write them down. They are the foundation of everything else in this video. The second number is 1983. That is the year these thresholds were established. A second adjustment was made a decade later in 1993, when the 85% tier was added. Since then, the thresholds have not moved, not once, not by $1, and here is why that matters in a way that most people have never had explained to them clearly. Almost every other significant number in the Social Security system is adjusted for inflation automatically. The wage base cap for payroll taxes, the benefit calculation itself, the cost of living adjustments to your monthly check, all of it adjusts. These tax thresholds were specifically, deliberately excluded from those automatic inflation adjustments. If they had been adjusted the same way as other parts of the system since 1983, the 50% threshold for a single filer would sit at approximately $81,000 today, rather than $25,000. The 85% threshold would sit at approximately $108,000, rather than $34,000. For married couples, those equivalent numbers would be approximately $103,000 and $142,000, rather than $32,000 and $44,000. Those are the numbers that were intended. What the actual thresholds have produced, by staying frozen while wages, benefits, and cost of living all moved upward for 4 decades, is a tax that now touches roughly 50% of all Social Security recipients, compared to the approximately 10% it was designed to reach when it was first introduced. That brings me to the third number. The third number is 50%. Nearly half of all Social Security recipients in this country currently pay federal income tax on some portion of their benefit. When this tax was introduced in 1983, the design intent was to apply it to higher income retirees, roughly 1 in 10. The reason that 1 in 10 has become nearly 1 in 2 over 4 decades is not that retirees suddenly became wealthier. It is that the threshold stayed the same while everything else moved. Every year that Social Security paid a cost of living adjustment, the monthly benefit increased, and with it, the half of the benefit counted in the combined income calculation. Every year that general wages increased, the pensions and retirement account distributions being drawn by retirees also increased, but the $25,000 and $34,000 lines did not move. So the population sitting above those lines grew steadily, year by year, without a single new law having to be passed. This is the fourth number that matters: how many people this tax was designed to reach versus how many it actually reaches today. The gap between 10% and 50% is the compounded result of 4 decades of frozen thresholds in an inflating economy. Let me make this concrete with real dollars, so you can see exactly how this plays out for a typical household. Consider a married couple who have reached the age where required minimum distributions begin from their traditional 401k. This year, that requirement forces them to withdraw $50,000 from their account. Additionally, each spouse receives $1,500 per month from Social Security, $36,000 combined annually. Their combined income for the year is $86,000. To calculate their combined income for the Social Security tax threshold test, add their $50,000 in RMD withdrawals, any other income sources, plus half of their $36,000. Social Security benefit, $18,000. Their combined income for threshold purposes sits well above the $44,000 married couple threshold. That means up to 85% of their $36,000 Social Security income, $30,600, is added to their taxable income on top of the $50,000 RMD. They are paying ordinary income tax on $80,600 in a year, where they may have planned for significantly less. This is the kind of retirement tax calculation that surprises people who spent their careers thinking of Social Security as a tax-free benefit. Now let me show you the same household with one structural difference that changes the outcome dramatically. Instead of a traditional 401k with RMDs, this couple built their retirement savings in a Roth 401k. In a Roth account, contributions were made with after-tax dollars, meaning the money was taxed going in decades ago. Withdrawals from a Roth are tax-free. And critically, Roth accounts have no required minimum distributions during the owner's lifetime. If this couple chooses to withdraw $50,000 from their Roth to fund the same retirement lifestyle, that $50,000 does not count toward their combined income calculation for Social Security taxation purposes. Their combined income for threshold testing is only half of their $36,000 Social Security benefit, $18,000, which falls well below the $32,000 married couple threshold. After the 2026 standard deduction of $32,200 and the age 65-plus additions, this household could potentially owe zero federal tax. Same spending, same lifestyle, same Social Security checks arriving the same day. Dramatically different tax outcome, purely based on which type of account the income came from. This comparison illustrates something that is more valuable than waiting to see what any new tax legislation decides. The mix of account types you are drawing from in retirement gives you meaningful control over your Social Security tax liability right now, under current law, without Congress having to do anything. Now, I want to address the broader policy debate honestly, because it deserves a fair presentation of both sides. There is a proposal to eliminate federal taxation on Social Security benefits entirely. The argument for elimination centers on the fairness question. You paid payroll taxes throughout your working life to fund this system, and taxing the benefit on the back end feels to many people like being charged twice for the same money. That argument resonates particularly for retirees whose Social Security check is their primary or sole source of income, and it becomes more pointed given that the thresholds were never adjusted for inflation, despite everything else in the system moving. The argument against elimination focuses on revenue. Independent estimates suggest eliminating this tax would reduce federal revenue by approximately $1.5 trillion over the following decade. The Social Security trustees already project a funding shortfall by the mid-2030s. Eliminating this tax would, by some analyses, accelerate the timeline of that shortfall by approximately 1 year. It is also worth understanding honestly who would benefit most from elimination, and the arithmetic here is perhaps counterintuitive. Lower income retirees whose total income already falls below the thresholds are often not paying this tax at all. The households who would see the largest dollar benefit from elimination tend to be middle and upper middle income retirees, the ones sitting squarely in the 85% bracket because of the combination of Social Security, pension income, and required retirement account distributions. Knowing this does not tell you what the right policy answer is, but it does tell you something important about whether a given proposal primarily helps the retirees who are struggling the most, or primarily helps the ones who happen to be paying the largest amount in this particular tax. Both of those are legitimate policy considerations. I am not here to tell you which weighs more. What I am here to tell you is what you can do right now. Under current law, regardless of what any legislative proposal ultimately becomes, there are three things. The first is to calculate your combined income precisely for this year and find out exactly where you stand relative to the thresholds. Your combined income for Social Security tax purposes is your adjusted gross income, plus any tax-exempt interest income, plus 50% of your annual Social Security benefit. If you are a single filer and your combined income is below $25,000, you owe no tax on your Social Security. If you are below $34,000, you are in the 50% zone. If you are above $34,000, you are in the 85% zone. For married couples, those lines are $32,000 and $44,000. Knowing exactly where you sit tells you how much room you have to work with before the next tier. The second thing is to look at the source of your income. As I showed you with the 401k versus Roth comparison, income from a Roth IRA or Roth 401k does not count toward your combined income calculation for Social Security tax purposes. If you have a mix of traditional and Roth accounts, drawing more heavily from the Roth in a given year can keep your combined income below the threshold. This is not a loophole. It is the designed behavior of these two account types, and it is exactly why having both kinds of accounts gives you control over your tax situation in retirement. The third thing, and this connects to a video I did recently on the Roth conversion window, is to consider whether converting some traditional IRA funds to Roth over the next 2 years, before December 31st, 2028, makes sense for your situation. A smaller traditional IRA balance means smaller required minimum distributions in the future, which means less income in your combined income calculation, which means a smaller portion of your Social Security benefit is taxable. The Roth conversion does not eliminate the tax. It shifts it to today, at current rates, rather than deferring it to future years at unknown rates with potentially larger distributions. Whether that trade is favorable depends on your specific income, your account balances, and the IRMAA considerations I covered in that earlier video. But for many people in the early years of retirement, the math of converting now and reducing SS taxation later is genuinely compelling. So let me bring all four numbers together. $25,000, the threshold that has not moved since 1983, while everything around it has. $34,000, where 85% of your benefit becomes taxable. 1983, the year these numbers were frozen while the rest of the system kept adjusting. And 50%, the share of Social Security recipients who now pay this tax, compared to the 10% the system was designed to reach. Those four numbers explain why this issue touches so many retirees who never expected it to. And the three actions I described, calculate your combined income, manage your income sources, consider your Roth conversion opportunity, are what you can do about it right now with tools that already exist under current law, regardless of what any future legislation decides. In the next video, we are going to go deep on the Roth conversion strategy specifically, the 5 concrete steps and the 3 ceilings you need to watch. Subscribe if you haven't, hit the bell, and I will see you in the next one.